So one way to think on this presentation here is the summary of the research of the quant team on the IPOR Labs, right? So we've been digging into some of on-chain data for the last 12 months, and then I'm kind of just want to share some of the good stuff with you guys. So yeah, it basically focusing on portfolio optimization on DeFi protocols. So for the busy people on the room, let me start at the end. So we also know like where we are gonna go, right? So what I want to talk with you guys mostly today is building models and how through data plus model we can quickly identify risks and opportunities on the blockchain. So here is one example that don't bother about the names. Is really the idea. The reason why I didn't put the name of the data is really I think you can abstract this to different pools, tokens, different asset classes, and everything. So this is on purpose. So the idea, and that's what we're going to do for a couple of protocols, is imagine that you start with a couple of data points that you understand, maybe a couple of protocols that you know very well. In this case, I started this model with these 3 dots only. And then I plotted this model, which is really the efficient frontier. I'm going to talk in details in a little bit. So this is the blue line. And then later, I just add more data, right? Maybe new pools that come up later, or maybe new pools that I don't really fully understand. And then very quickly, I can identify that they just jump out of the screen some pools or some assets that they're just weird. Like why they are beyond this frontier, for example, or even like why these guys down here that's type of stuff starts like shouting out at you, and the reason why I think this is so interesting, and that's why I want to share with you guys, is like the whole DeFi with points, leverage, all these marketing things going on Twitter is very hard to get information, and despite of all this chaos and noise, these models still work, and that's why it's so interesting. And then that's why I want to like guide you guys through this whole like discovery process and how can we build on that. So the point of this presentation, I hope you guys stick to the end, but just so you know where we are getting, is that turns out many of the traditional models, especially on the risk reward modeling, it's quite effective on DeFi to detect some of outliers and some risks. And then if you get interested in doing that by yourself, we have a bunch of tools, open source tools that you can just download and start playing for yourself. Right. So this is basically what's going to happen today. I hope you stick to that, even though now you have the takeaway message. So what's going to happen? So I think it's amazing the portfolio optimization works in DeFi. So we're going to start talking why I think it shouldn't to begin with. Then very quick basics on DeFi. I bet the guys here in this presentation don't need most of it. So it's going to be like maybe a 30-second overview. Then a little bit of portfolio optimization, right? So we're going to do some use cases. There are different situations with limitations and restrictions on the portfolio. That should be some good stuff. And then the meat of the presentation, some of the findings that we got through the last like 12 months in 2024 in DeFi, right? So especially focusing on yield optimization or optimization stuff. So there are a couple of good stuff here. Then we just bring home with how can you guys do your own strategies if you want to do your analysis or deploy some strategies, like what are the toolkits that are available to just expedite your process that allow you to focus on analysis and strategy. And then yeah, for the QA, just I hope you guys have a lot of interesting questions because I could talk about this for the whole evening. So yeah, we get some questions at the end. So okay, so why portfolio optimization should not work on DeFi? So when we look at this, right, so okay, so imagine that I come to you and say, hey buddy, like you're doing your investment strategy and thinking, I tell you, yeah, it turns out the risk reward modeling works very well in DeFi. And you're gonna say, like, duh, like of course it works, like everybody knows that. And I say, yeah, it kind of should work, but then all the memes they came, and that really messed up everything. Like if you guys remember what happened in 2024, one of the narratives was on the point system, right? How you get points stake on different protocols. It was a nightmare for modeling that stuff. In a way, points is like the antithesis of modeling, right? It's just like this cat and mouse game. So what I mean by like then came the memes is really this idea that the noise to signal ratio in crypto space is actually very high. So to be honest, this is incredible, and I hope I can blow your guys' mind as it blew me away when I figured it out. That it can be so effective, right? To filter out the noise from Twitter space and all these like news coming from different sources and what it means, all those tokens. You can actually look at the data, and there are some tools to allow you to actually use these models that turns out they actually do, right? So this modeling on top of the data is just an interesting way to quickly like unpop your game on DeFi, right? And I guarantee you in 2025, you will see a token that you never heard about. There will be a pool that you never heard of. And you're gonna need to mentally put that new token, new pool along different assets that you already know and understand where are the risks. So I think this type of a lot of this tooling is going to be very important, like for not for the existing pools, but like in the like very near future, like next year, you can already start using these tools. So let me try to translate this problem in a very like what type of problem we are trying to solve here. And then there is an interesting example if you think on traditional finance. So I just want to build this example with you guys so we understand what type of problems we are trying to solve. So imagine here that I come to you and present you this portfolio, right? So this portfolio has no Bitcoin. It has exposure. It has like looping PT tokens of Bitcoin. So like there is some exposure to this the notion of Bitcoin, but like the token itself is not there. So imagine I come to you and I don't know these crazy names, and I just tell you, hey, is there any problem with this BTC portfolio? And yeah, like it's not even a BTC portfolio, right? Or imagine that I even have points on top of these tokens or pools. Like I'm really lost if I come to you asking about this Bitcoin portfolio with all these pools that has not really a token. But like, so on crypto, if you're not familiar, it's quite nasty to realize that. So how this problem could be translated to traditional finance, so we can have a feeling of like how important it is to have this tooling to really like separate like different tokens and different asset classes, different risks, right? So imagine that on the flip side, I come to you and say, hey, look at my Apple stock portfolio, like my equity portfolio with Apple shares. Like, do you see any problem with it? Again, this question doesn't even make sense because this particular portfolio doesn't actually have Apple stocks, right? Apple shares. So, for example, this instrument, like 10-year bond on the Apple company, like a bond is not an equity, right? It's similar to like if you're staking a pool with BTC, it's not like you're actually holding the assets. You get exposure to interest rates on that, right? It's a different beast. I have like you could have options that expired like 30 years ago. I like this last one. So shares on Apple International. So Apple International, it's actually a ticker on the Tokyo Stock Exchange. I'm actually based in Japan. So this is a token company that happens to be called Apple, but like it's another thing in another market, right? So you imagine a token that happens to have the same name in another blockchain. So yeah, so through modeling, you could see even if you make a mistake on try to put this data, you're gonna see quickly there'll be these data points that just gonna scream that they don't belong there, right? So the problem with this portfolio, there are no Apple shares. So imagine now you go back to crypto, you're presented to this portfolio, and like, what is the problem with this portfolio? Like, it's like it's a lot to take in if you've never like seen all these pools and all these protocols. So, and again, into 2025, you will see a pool that you've never heard of. So you always gonna be like, I don't know this. How could I possibly get some information out of that? So one idea, just throw a model on top of that. Right. So in this example, you would quickly see some of those pools, some of those protocols, of those Apple International shares. They would be in a different place on this space between the modeling and the data that you already know. So why should you care, right, about this type of presentation, this the modeling? I think one way to think of it's like this DeFi, the total value locked on DeFi in November that I collect this data. It was roughly $200 billion on like assets locked on different protocols like Aave, Compound on the money markets, but also on protocols like Uniswap. So yeah, that's more or less the size of the market like last month or a couple of days ago. While at the same time, I feel that this like what I have to share here is mostly applicable to any assets that you don't know. And again, they will come. This is crypto. So okay, very quickly, basic on DeFi. The main reason, the main topic I want to cover here is just to contrast how complicated these models are compared to the simple modeling and how incredible they're gonna be. So buckle up for a few minutes. So I bet most of you guys already know about interest rates, how the modeling on DeFi. What I want to highlight here is mostly this dashboard that I created that allows, like, it's a really good tooling to explain how the modeling works and how different parameters they yield different interest rates on the blockchain. So yeah, if you guys want to play here at some point or use this to explain to people, I think it's very interesting. Like, right. So if you guys remember, the interest rates, they're basically like a couple of parameters, like these slopes, right? There are two slopes with the target interest rate, with the utilization rate, basically how much is supply to demand on the assets itself. And this is the formula for Aave interest rate. So there are a couple of parameters like the different slopes, optimal points, utilization rate, and all that. So again, the main takeaway of this particular slide is just keep in mind this formula that is it's not super crazy, but also not super simple, right? It's just all these parameters that happens to be what needs to be taken in consideration when like doing the optimization. And then now imagine that you're doing your optimization, right? That you have to decide, how do I allocate my assets on chain? So essentially you have those models, right, with the slopes and everything, and now you have to choose between different protocols. They have different slopes, different parameters, but also different amount of funds, right? The different utilization rates. So the job, right, your role, if you want to do the optimization, is like, how do you decide between all these protocols? However, it's a little bit more complicated than that. Right? I like to think is this idea of like turtles all the way down, because it's not only thinking about the protocols themselves, but now you have to choose the chain, right? You might be allocating funds between like multiple chains. So you have to choose multiple chains with different liquidities, where they have different protocols with different parameters. So it's like a nasty optimization problem. And again, the highlight here that's going to come in a couple of slides is like how the modeling is so much simpler than all this massive train of thought that you need to take into consideration. So, okay, so why do I even care about this problem, right? Just a quick word about IPOR. So IPOR, we have like this, like IPOR Fusion, which is basically an on-chain portfolio automatization toolkit for asset managers, right? So we have multiple strategies running like different like asset universe of assets. So they need to, like, in a way, they are building different models, and they have to take into consideration different aspects of the market on a block by block basis. So for example, take this strategy, right, which is yield optimization, like what I was describing. So every block needs to decide, like, am I allocating funds somewhere else? Am I happy here? What are the state of the market? What are the parameters right now? And then in a way, so take this snapshot, right? So I think I took that yesterday, where this particular moment, the strategy decide, right? The optimization decide that we're gonna allocate 60% of the funds on Aave, 25% on Fluid, 10% on Compound, right? So like this data coming, like main chain, like Ethereum, it basically deciding through all these parameters, like, okay, like how do I decide where to put, right? So that's basically why I care, right? So we need to make the decision like on a block by block basis for multiple strategies for different universe of assets. And then yeah, it's very important that we don't mix up like risks, for example, if that's not necessary. So yeah, so that's why we care. And okay, so let's talk a little bit now, portfolio optimization, right? Just I promise that's gonna be like 2 slides with equations and I'm done. So please buckle up, but I promise it's gonna be worth it. So when we think about optimization, there are three things that are, I think, the most important that we have to take into consideration. So one of them is the returns that we expect on the different assets. So imagine you're going to optimize between all the USDC pools on Ethereum. So you need to take into consideration like the expected returns that you have for those pools. Then you have this volatility, which is basically like how they move over time, but also how the rates of those pools move together, right? So it's like this covariance matrix where it's the variance of the asset itself, but also, yeah, how they move together. So, and then the third one are the constraints. So the constraint is like, maybe I'm allowed short, maybe I'm not. Maybe I have a hardcore constraint of I'm not putting more than 5% on a new protocol, or I'm allowed up to 80% on a bigger protocol, or different like mix and matches of constraints. So again, so the key three things that we need to think when optimizing is like expected returns of the universe of assets, the volatility, like the risk of those different pools and how they move together, and then what are the constraints of the problem. So this plot we're going to see multiple times or multiple strategies. So let's spend like 30 seconds just refreshing how to read this type of plot, right? So imagine here that we have only two assets, so two pools. So let's say we have like Aave pool and Compound also in USDC, both. And these like the blue and the yellow, right? So from this universe of assets and universe of pools, I can build my own portfolio. For example, this portfolio one has 80% of my funds on the blue pool, so in this case Aave, and then 20% on Compound, on this orange pool. So in this particular example, we could say that the protocol the portfolio returns, they would be here, right? Very close to this green line. While we could have different portfolios in different places. Our role when we think about optimizing the portfolio is, in a way, what we're trying to do is, given any level of volatility on the x-axis, what is the maximum return that we can get at that level given the universe of returns? And this is this green line, right? So the optimization problem can be translated in trying to find what is this green line. So we can imagine that an investor comes and say, hey, I have this risk appetite, give me the best returns, right? What should be my asset allocation to get that the best returns given this risk that I'm intended to take, right? So we can translate this problem. I mean, given a volatility on the x-axis, find the best R, like the best return on the y-axis. And then turns out this particular problem, like with quite simple problem, happens to have a very simple solution, bro, like a closed form solution. And then you may say like, oh yeah, like, so you have like matrices, inverse. You may think like it's quite nasty, but what is crazy and blows my mind is already with this type of model, you already have some red flags here. For example, maybe you're not aware, and if you're not, that's it already highlights how powerful this is. So this particular point is from Morpho Aave. I don't know if you guys remember it last year, beginning of this year. So Morpho Aave started with this particular pool, was some sort of mid-market between Aave rates. And over time, they were really trying to shift away from that pool. So they were disincentivizing heavily. So there is a massive, like, it becomes a different beast, like putting your money there, right? Like stake on that pool, you're really taking like some different risks because of all these things external from the pool, right? So, and if you don't know that, that's really even highlights how powerful this toolkit is, because already screams here that this protocol kind of doesn't belong here. And we're going to see on the next slides with different models that it screams like louder and louder. So yeah, so already here we have this, and that's why it's so crazy. Please, I think, and I hope you guys already starting to understand how it is, because this model doesn't have never seen a blockchain. There is no parameter for optimal utilization rate that we saw on Aave. It doesn't have like the slope of different models. It doesn't have number of side chains. It doesn't have like point allocation distribution system. When the points will expire or whatever, it doesn't have none of that. And still, it's so powerful. And this really blows my mind. And that's why when I saw this plot for the first time, I was like, no, 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 more people needs to know that, because it's just quite, I think it's quite impressive that actually it works as in a way it's supposed to do. And when it doesn't, like points like this, it's like, oh, something you should take into consideration. So yeah, so something is up and this model somehow knows. So the next couple of slides, I'm going to go quite quickly, but it's the same idea of optimization, but now we're going to put some constraints. So for example, I'm not allowed to short the Aave rate, right? I can only borrow. If I want to short, it's a different rate. So I'm going to do the same optimization problem, but now I can only stake, right? I can only deposit on the pools, right? So this is basically how you would frame the problem. And then it started becoming more like this quadratic programming framework, right? And again, we have tooling for that. If you want to play with that, we're going to give you some links. You can download on Git and start playing with that. So, and if you want to frame the problem in a way that you can only go long, you can only deposit, this would be how you would frame the problem. And then the solution for that particular problem with only depositing would be the black line in this particular case, right? And that's where you can already see that this is really it really feels like it doesn't belong there, because imagine that you took this rate, right, from this pool, like the solution would be lower, right? So there is no way to get there from the existing instrument. So you're really taking extra risk. Maybe you're okay, like maybe that's the risk you want to take, but now you know. And then, okay, the next model is like how about market impact, right? The more money you put on the pool, the less money, like the less the rates become, right? So what we can approximate that with like two linear functions. And then what we've done here is basically adding an extra term that really like mimics this idea of decreasing the return, the more assets you put there. This particular model has a couple of issues, which I leave you guys for homework, because we already have a second version for that. But it's still super powerful despite of edge case issues. And then why it's so powerful, it's just very quick to compute, and you have a benchmark of at least a feeling where it should be. And yeah, so this would be the solution with like market impact and borrow only, for example. And right. So the point here on this last couple of slides, there is this white paper on Git. You guys can go have a read, ask questions. Again, I could spend like the whole evening talking about that. So I'm gonna pause on the optimization for now and move on. But yeah, just go crazy, and yeah, we can talk about that later. More than happy to talk about it. So okay, so now that we have some feeling of like the importance of those models, how crazy it is they actually work, what we've done is like, okay, so now let's take all this math, all this modeling, and apply on actual data and actual markets and see what can we find from that. So what I'm gonna share is basically our finds in 2024, and yeah, that I think is interesting. So I hope you guys enjoy. So first, this is the yield optimization strategy that we built, right? So for most of the math that we were talking in the first slides, we came to the conclusion that made sense to have a optimization strategy that basically consider a universe of pools on this particular plot, USDC on Ethereum, and then start allocating like the assets, right? So what we found with this strategy in production, right? So it's running main chain since October. So we got to, at times, we got like even a more than 6% higher returns than market portfolio benchmark rate. And that's already like hints like, yeah, there's room for yield optimization on the blockchain. So again, maybe you already knew that, or you already thought that, but now we went there, look at the data, made a strategy and run, and like, oh yeah, so it's there. The other takeaway that I think is very interesting, again, everybody knows that, everybody thinks about that, but I went to the data, I saw that, and built a dashboard so everybody can check. Right. So the next takeaway is on the single looping, right? It's just one leverage looping, where like the optimum level of leverage and depth of the capacity of the strategy, it changes over time. Again, this particular one, probably you guys already had a feeling about that. I just went to the data, made some calculations, a quick dashboard that you can like quickly play with it, and now you can just check yourself the parameters, right? So for example, on this strategy, I was just checking but this particular moment here, it gets negative, right? So despite the fact that it goes back up, on this particular massive, like the max leverage, you're still gonna hit negative levels at points. So what you could do is actually change your leverage to something more amicable, for example. So at times there are more like stressed market, you still would have like a positive P&L, right? So that's really preventing you from get slashed, for example. So yeah, so basically the takeaway here is this idea that so the optimum parameters change over time. So now you have to think, okay, how can I automatize the process if this needs to change over time, right? Just as a curiosity, this particular market, it's on base where you're basically yielding the rewards, and that's why you're just looping on the same asset, right? So yeah, so that's basically this particular dashboard. But what's interesting on this tooling, you can just bring your own ideas of looping, and then you just make your own dashboard and have go crazy on your parameters, for example. So the last one I think is the most interesting, which is, and also really like puts everything we've been building for the last like couple of years into this optimization, like characters of all the way down, like type of thinking, which is we did, I ran like looping on like many pools on multiple chains. Then from those strategies, I built optimizer, I optimized on top of that. So now my universe of investments, they are not pools, but they are the strategies, right? These looping strategies with different leverages, different capacities on different chains. So now how can I choose the best strategies that I have access to deploy my capital in a way that's going to be like more efficient and with more returns? And what we found is that a way very straightforward, I mean, given that you have the automatization and the strategies, a way that is very straightforward to increase the capacity and the returns of the strategy is basically distributing between multiple looping, like paths, looping pools. For example, imagine that you start here. We did this with roughly $10 million as for market impact. So imagine that you start here, you have a $10 million, and you start put everything on Aave V3 for USDC. For Ethereum, staked Ethereum looping. And then that's fine, right? So that's a pretty decent returns. That's the highest you can get with choosing only one pool as your like strategy. But then imagine that somebody comes to you and say, hey buddy, I got 1 million more. Do you have capacity from 10 to 11 million on your strategy? And then to a certain extent, you could just put another million on that particular looping, but that's going to decrease the P&L, like the returns of this strategy. So what we found is that instead of actually putting everything on Aave, in this particular example, you just put the extra amount, 10% on the Spark, right? The basically a fork of Aave, but you are still like spreading the assets between multiple asset pools. Now imagine again, somebody else comes to you and say, hey buddy, I got yet another million. Can you allocate on your strategy? And what you could do is like, okay, sure, let me now distribute from a different way between Spark and Aave. And this would be better returns and also accepting more capital. But also you wouldn't get here with only 100, right? So you need more capital to get to that level. And again, you could do that with like a third million, and then you would allocate with different choice of allocation pools. And yeah, so this is basically what we found on the loop optimization side, where it's quite efficient on the return, but also on the capacity of the strategy to choose between multiple pools. And this And I want to expand this on even more pools, probably even different loopings. And yeah, the future is also on multiple pools. It would be super, multiple chains. It would be super interesting to see a plot like this on multiple chains. So, okay. So imagine, hopefully by now you are as blown away as I was with all this modeling and the math. And you think like, okay, cool, but how can I do my own strategies or my own ideas? So we have like the whole menu, right? You, in whatever stage you think you are, there's stuff for you to do. For example, maybe you have some ideas on your mind, but you never coded that idea yet, or you don't know if it works yet. We have a backtester we call dope, right? So DeFi Optimizer here on my background. So you could start there. We have event-based backtesting, optimization, all the plots that I for this presentation basically from dope. So yeah, you guys could go there and start playing with your own ideas and find something. Or you already have like a strategy and you're just ready to develop, right? So you can just jump on the SDK and yeah, just like start integrating your strategy to event on the blockchain itself. Or you already have your strategy ready and really just ready to deploy. Yeah, you can just go to Fusion, for example, and really just like bash your strategy on chain immediately. But one thing that is very interesting on Fusion, and then I'm gonna call Lukash right now, is I built like back when I built my own decks as well, and it's a nightmare. And but I really would really just want to focus on like optimization of assets, like portfolio management, basically, right? So I ask you, Lukash, like how can like IPOR Fusion like help me focus on optimization of assets instead of rebuilding my own decks again?
Well, managing your own strategy can be a complex task, and IPOR Fusion is built to make that process a lot more straightforward. In the next 4 minutes, you will get to know the basics of what IPOR Fusion is, what can it do, and where to go if you want more. So can we go to the next slide? Oh, thank you. So there are main three parts of Fusion. The first one is ERC 4626 Vault. It's essentially a central part of the Fusion. You can build those vaults public or private, and the fees also charged at this level. So down below you see fuses. Okay, so fuses are small, atomic, stateless contracts. They're non-upgradable. And they act as a way to connect Vault to external protocols, external DeFi protocols, DEXs, and so on. So through those fuses, the Vault can deposit assets, it can borrow assets, can swap, it can claim rewards, etc. Those kind of things. So, and last but not least, you see to the left, is our automation, or how we call it, or alpha. This part is optional since the vaults can be managed manually, but Fusion vaults are designed to be automated. In fact, all the strategies that are currently live on IPOR Fusion or are being developed are automated. Fusion makes transacting with various protocols easier, so that you as a strategist can focus on building the strategy and delegate that interaction with contracts to an automation. So let's talk about why would you want to build an automated Fusion vault. So let's consider this vault. How can you change slide? Thank you. So this vault has been live on Base for about a month now. And it's been consistently outperforming the credit market. It's credit markets is connected to as a portfolio, but also each one of them individually. This particular alpha that's running this vault is aware of its own influence in the market. It can handle like anything from a couple $100 to several tens of millions of dollars. So it's aware of its own influence in the market. It's aware of gas prices, incentives, and sometimes incentives change, the price of tokens it manages. And it's constantly updated to adjust the strategy. So you can actually change your strategy, add more protocols, remove the ones that you don't want. And you can plug in new modules for like risk management and so on. If you can change the slide again. So the alpha, alpha is limited to rules and regulations imposed on-chain by the owner of the vault. Additionally, its actions can be time locked, and that time lock, I mean, this is in situations when the time is not of the essence. But alpha can be programmed to optimize yields and manage portfolios of assets, loop, and we have examples of that as well, manage liquidity on dexes, stake tokens, claim rewards, sell rewards, and even more sophisticated strategy. Or it can act as an emergency way to withdraw funds from the market. Additional security on top of that, it can be run through a dedicated role called a guardian, which can automatically pause the vault or reject the time-locked transactions. Some strategies, like the credit market deposit optimization that I just showed you on base, they're more profitable with the automation, okay? But some other strategies may require automation, especially in the volatile conditions, like when collateral value changes constantly and the interest rates go up and down. So the automation can help you tremendously with things like, managing interest rates or interest rate movements, changes in the incentives. We see the Moonwell actually, the strategy on Moonwell pools changes very often. DPEGs on LSTs, if you use LSTs as collateral, they can DPEG, and you can actually monitor that in real time, not waiting for Lido. Hikes in LTV caused by the prices changes. And you can also, do emergency actions when there is hacks and exploits on the markets that you deploy to. So now, let's talk about how. So management, as I said, can be done manually through the Vault's ABI, but we recommend using our SDK to abstract the complexities of the smart contracts. So you can find it on GitHub right now. It's an open repository. The link will be in the description. For integration examples, I encourage you to check the test folder. There you will find actions like swaps, managing DEX liquidity, deposits to credit markets, and so on. It's a living product. It's a living project. So if there is something that is missing there that you need for your particular strategy, just use the issues section and just request features there. Also, feel free to fork it, star it. It's going to be a nice project to watch. The SDK is self-configuring, so all you need to do is supply the Vault's address, and it will pull all the configuration from on-chain onto the SDK, and you can run it on the fork. So you just use the existing Vaults if you want, and just go and have fun with it. The factory for permissionless creation of the Vaults is not available yet. But if you want a dedicated vault that is configured to your strategy with all the fuses configured and connected, what you can do is to use the type form that's also in the description to request the vault. It has all the questions that we need answered to bootstrap the vault that you can eventually use, hopefully in production. And if you're interested in building the automated strategy and have IPOR Labs help you with the automation, we're also here to help. My name is Łukasz. I'm the head of product development at IPOR Labs, and also my Telegram handle is in the notes. So feel free to reach to me, and I'll help you through with that process. Thank you very much. Back to you, Mom.
Thank you, Łukasz. So let me give an example of how the flow works. For example, using our backtest, right, our dope. So how dopes look like at the moment, right? So the idea is that you can do your whole back testing optimization, just a couple of lines of code. So for example, you just want to grab some data and see how it looks, right? So you can, with again, a couple of lines of code, and you have all the data from all these pools plot on the same timeline. This is something that blows my mind, that is super hard to find on DeFi. I'm sure it exists somewhere. I've never seen, but here, which very quickly you choose the pools and you can see there is something changing the market from April, May, March of 2024. So now you know, maybe you want to drop some pools on your analysis, maybe you want to do your analysis before or after March, but that's something you do on a couple of lines of code and just think, like, I have some ideas and I want to test. I don't want to deal with anything else. And that, yes. So just grabbing data, using dope to grab data, it's already so much easier and already give you something. But it doesn't stop there, right? So we have the market impact, as I was talking about the optimization. So we have a couple of different market impact models. So on the left side is the one that I was talking on the white paper. It has a couple of issues on the edge cases. So that's why we developed the one on the right. And the idea, we have a video here of what dope does on the background. And the idea is that, So the idea is that you don't have to worry. And that's the point of the video. There's like so much stuff going on every second, every frame. And all that happens on the background of dope when doing the backtest, all the accounting and market impact. And at each decision point of your strategy, dope just do the proper accounting and proper estimation of market impact, depending on the market, depending on the assets, depending on the volume of your strategy, right? So yeah, so what happened on this strategy is basically a lot of things happens on the background on dope, and you don't have to care, right? So again, a couple of lines of code, and you have your market impact model just throw on your backtest, and it's gonna get you the market impact. And then finally, a couple of lines of code, and you have your backtest. So we have a couple of strategies pre-coded, some already doing optimization, some doing very simple, like dummy decisions. You can code your own strategies, and again, they're just event-based, and you just run your backtest on a couple of lines of code, a few more lines of code, and you get your analysis. What's the progress of that strategy? And then what we used on the optimization on top of looping is this idea you can save your backtest to disk, so maybe you can share with your team, or you load all the backtests into one analysis, and now you can see that you can optimize on top of your strategy, right? So it's built with this idea of turtles all the way down, where you can even think of some sort of like fund of fund type of like asset management that you want to build with analytics, right? And everything happening on the background in such a way that you just focus on analysis. And the most important, I have to admit, if we start using something like dope, you're going to start understanding some of the memes we post on Twitter. So I would say maybe the most important effect of today. And then, okay, just to wrap up, what did you learn today, right? So one is like there is some room for yield optimization DeFi. I think that's very powerful. Maybe people had a smell for that, but we went there and we did it. The other one, I think that's very obvious, but again, I went to the data and saw. So leveraging looping requires dynamic parameters. So you can also coach dope and then play with a dashboard. Maybe have some looping strategy you want to check. Very quickly, you can just get your looping there. And then finally, that's, I think, very interesting, which is the leverage looping optimization could be a really interesting way to increase the capacity, not only the returns, but also the capacity of these strategies. And that's basically it. Thanks a bunch. I think now we're gonna open for questions. So again, if you have, thank you guys. So if you have some ideas and you want to test the ideas, you can just go to a backtester. If you're ready to develop, you can just grab our SDK, or maybe you're ready to deploy. Just go crazy to Fusion, and yeah, there's like we have all the tastes ready. And yeah, if you wanna just have some custom requests or something, just hook us up on Calendly and just let us know. We are eager to make analyses and strategies and help you guys.
Hey, Alex. Yes, you are now a contributor. You should be able to speak, or yes.
Hey, so it looks really cool. Firstly, and congrats, guys. It's really awesome. How do you get the data for some of these backtests that you're running? Like, where's the data source for these? And do you need to provide your own API key if you're going to use this, or is that kind of batteries included?
Yeah, so, yeah. So we have a couple of data. So one that is very convenient in the way I designed, so people can download and start using right now. Is just plugged in on places like CoinGecko free APIs, DeFi Llama free APIs. So that's one level on dope that you can immediately start running. You don't need nothing from us. We are we have data on our database. Maybe that's necessary. We can find a way to hook you up with that data that might be block by block base, maybe hour by hour base. But yeah, so these are the two paths right now. You can just download dope and then start getting data from different places already available. But yeah, I don't know if I answered your question.
Yeah, and then I have a follow-up question, if that's all right. On how long does it take to generally run a backtest?
So depends on the granularity. So the way I usually do, I do like only on daily data. So it's closed rates on a daily date, and that one of those runs, it may take like, let's say 30 seconds. And then once I get some parameters, I get a feeling, okay, let me try hour by hour. Now it's going to take a couple of minutes. And now one backtest is usually not enough. I want to do the optimization. So it could take like, yeah, now it starts adding up. But yeah, that's usually the cycle it goes. A couple of seconds on a daily basis. I try to understand the pattern. Maybe I just want to test a small period. And then I fine-grain the data there and they start taking a couple of minutes.
Cool, thanks. It's really awesome.
Thank you. I hope I answer your question. I see more people with the hands raised, so I guess we're getting more questions. Hey, Max.
Great presentation. I had a question. You're plotting a return based on volatility. But if we are talking about a pulse, why is it relevant to have volatility as a measure of the risk?
So one of the justifications I had to myself is to think the volatility as a measure for uncertainty. So that's one way to think about it. So maybe imagine that something that would be more volatile is just maybe you're not really sure. Like the more volatile, the less sure you are on this trend of the volatility. That's one way. One volatility like proxy we've been thinking it's something maybe volatilities with spikes down only, right? Some skewed volatility. But yeah, so these were the ones that we were thinking. But yeah, I don't know if this answers your question. Did you have something else in mind?
Yeah, it will be there like a better measurement than volatility to measure risk, or is it like the best metrics to?
I mean, I don't know. The best metric is the best answer, the best way to think about it. So I think on this idea of uncertainty, right? So one way to think about it is at least one proxy I think on my mind is something to like bonds, right? Versus stocks, where they have a different risk. So what exactly, like if you use the same idea of volatility, right? It really feels like you're talking about two different beasts. But okay, so there is this way to think, and then I feel this type of question that you're thinking, is there a better one? That's the way I think. Like that's the proxy it brings to my mind. But then thinking of this idea of like, okay, how can I measure some uncertainty of where my returns are? Yeah, I felt the volatility could be a first step. But no, I'm sure we can come up with something like more relevant, right? And I feel that probably like some skewed volatility may be counting more ups or more downs, for example.
Okay, thanks.
But I can hear the gears turning on your mind. Do you have any suggestion?
No, I have no idea about it. But I feel like
what makes you uncomfortable? What makes you uncomfortable with volatility?
Because if we're talking about bonds, like the underlying assets moves based on dollar, but if you stack dollar, USDC on Aave, like risk could be like not zero, but it's kind of different aspect of, yeah.
Okay. Yeah, I thought about that. Yeah, I thought about that in the beginning, and I was like, shoot, this sounds so. It would be so convenient if I use volatility now and think about that later, but I never went back in more details on that problem. But yeah,
Could it
I
be
feel
like volatility, warped volatility, where volatility of the, because if it's like pool if USDC, kind of like Morpho, could it be like volatility of the underlying assets versus the volatility of the yield?
it could be. I mean, maybe I'll write something, and maybe we can talk about that later in more details.
Yeah.
But what convinced myself to like, okay, maybe this is okay for now, is this idea of uncertainty. Because if you see the volatility, for example, there are times where USDT right now, I think USDC has like a crazy volatility. And that really smells like I don't really know where that level is going to stop. Like if you see the trend is like going up for the last 2 or 3 weeks, and the volatility is crazy. So if it really smells, the volatility is becoming this proxy for like, I don't really know where it's going to stop. While USDT on the same period had a lower volatility, and I could just look at the rates themselves, right? But yeah, anyway, yes,
Yeah,
that's a
thank you.
really interesting
Yeah.
topic, and I think about that a lot. Thanks.
Adam, the floor is yours.
Yes, can you
see-
hear me, guys?
Yes, we can.
Yes.
Perfect. Thanks for the presentation, by the way. Just, I have yet to really review the dope GitHub, but is there a way that we could load our own data sets? I'm looking at the Maestro function. That's the one that loads price data, right? Or token data.
Right. Yeah. So right now, no, there is no way. Though, however, it should be very easy to do if you have your data, and we could do it very quickly. I never bothered because there was no one asked, but yeah, we could. It can be done. Like I could do
I'm-
that and should be quick, but there's no
Sure,
functionality
yeah.
right now.
You could like even just like give the format that you're using, just so that people could emulate it. I could emulate it without you doing the work. I could give like just a modified Maestro function that uses my dataset. I think that could work.
Yeah, no, it makes sense. Yeah, I guess maybe a couple of messages. Maybe we could talk about Telegram, just like 2-3 messages. What would be the best way? But yeah, that can be done very quickly. Yeah, just never bother
thanks.
because no one. But yeah, that because also makes sense. One use case I have in mind. I don't know if you have that use case. I'd love to have a portfolio manager getting dope, getting their own past performance, and just doing their own analysis. Right, I don't have to know about anything. So, but now they're doing the optimization. Like they have a new pool, and they have their existing portfolio, and now how do you mix them together? I feel that
Yeah.
dope could be a very interesting way to use that. Yeah, anyway, but yeah,
That's
definitely we can get that done.
cool. Thanks.
All right, anyone
any other-
else? Yes, if you guys have a question, you can just raise your hand and yeah, we give you access to the floor, or you can send a message in the chat.
Yeah. Okay, while we're waiting, I can show you guys a little bit of what's going on. There is one vault in particular I'd like to show. If you don't mind, Mal, just jumping in.
Should I stop sharing that?
Yeah, I'll share a screen if I can.
Okay. Yeah, sure.
There we go. Yeah, this one. So this is, courtesy of Tesseract. So this is the vault that we're ramping up right now. So you see, it's actually, what it does is actually quite interesting. So of course it's automated, and the alpha essentially runs the strategy where it deposits CBBTC, and then takes a loan against that on Moonwell and deposits that as a USDC, and then uses Flashloan to loop that. Right now it's almost 3 times leverage, but we'll be ramping it up this week. And yeah, so you see like here now there's more liquidity, and this is an allocation chart, but you'll see like it was getting in and out of the strategy whenever it felt like it was making some additional money. And and you know, you have a yield in BTC because that's your main asset. So yeah, I think this is pretty interesting that, you know, we're starting to see those solutions like the looping, and there's going to be more interesting looping on this one, I'm pretty sure. So yeah, happy to, if you have any questions regarding running Fusion, and I'm also happy to answer those.
Max is
Have
back.
another question coming. Welcome back.
Yeah, I'm back. We basically doing derivatives, and we are looking for, we have collateral in a contract, and we are looking to do something with that collateral. Like we could buy yield bearing, but I feel Hyper Fusion like having more yield. And is there some documentation on how could we like implement kind of fuse like you have, but to deposit into IPOR, and how, like if we have a liquidation on our side, how fast we can exit from IPOR with what with what spread?
I mean, the short answer is, you know, our repository is public, so you can have a look at how the fuses are built. They're essentially the configuration of the fuse, because you know they can be configured and they run their own validations, but it's done through the vault. So the best is to have a look at our repositories for both Fusion and SDK, if you use SDK to operate.
There is a question. We're looking like to make a contract that deposit into Fusion, but sometimes we may need to like recall back the collateral, and like how big, like how fast can we do it? How big is the spread in?
Okay, so this is an excellent question. So it depends on the strategy. So some strategies that we run, they have what we call an instant withdrawal. So this is when you can withdraw it, you know, pretty much the next block. There is this functionality. We have to prevent deposit and withdraw on the same block to prevent sandwiching. But yeah, for instant. However, there is some strategies that you cannot unwind like instantaneously through various reasons. You know, the slippage, and you know, trying to get the good deal on your position. So here it depends, right? So right now we're working with a vault that does looping, and you can withdraw the assets. It probably would take about 2-3, I would say about 3 minutes, but we can probably cut it down to, you know, by order of magnitude. It's just a question of getting a fast node connection to run simulations on the way out. So yeah.
I've been through a bit of the doc, and how do we know, like, how we get a sense on how much the spread if we withdraw early? Because in our use case, we need to know like how much the collateral is worth to kind of apply a haircut in it. So if we deposit 1, we'll count like at 0.8, something like that, deposited. So if there is like fast withdrawal or whatever, like we are still collateralized. Like how can we get a sense in a like IPOR Fusion?
Yeah, I'm not sure if I understand the question, but if you want to know what the collateral is worth, the vault can actually price it on demand, so you know like how much it holds.
Okay.
So we use this method to actually cash balances inside of the. You know, this is for gas optimization, so the deposits and withdrawals are cheap. But we will have like a new functionality very soon on the new vaults, where you can actually force the recalculation of the token price at the time of deposit or withdrawal. So that will essentially remove like even like a slightest imperfections in calculation. So It's on a scheduled withdrawal, because scheduled withdrawal, when you it's a two-step withdrawal for the vaults that you cannot instantaneously withdraw the assets. On those, the alpha essentially, which is the automation, can run the update of the cash on your withdrawal, but just before your withdrawal. Now, if you want to check the assets values, you can. The vault can actually has a method to do that with bypassing the cache.
Okay, is there like a documentation where we can see how to do it?
You should be able to see it directly in the code. Some of
Okay.
those very detailed questions we don't have in our docs IPOR.io, but now that you're asking this, I'm listening carefully what to expand the documentation with. So yeah, I don't want to make it too big.
Yeah,
But-
it's already big.
Yeah.
Good, cool, thanks.
And thanks, Max, for the question.
Cool. So one note on my side, that you'll be able to join this, as I mentioned, this closed channel on Discord and ask any question that is related to Fusion or Dope that you have. I guess the best way or the easiest way to get you on that channel is just to DM the IPOR IO X profile, and I will get you the role. Just DM me your Discord handle, join the IPOR server, and I'll give you the role so that you can enter the channel and ask any question. And I think with that, maybe we can close if there are no more questions. Just to let you guys know that over the next months we plan a lot of new launches. So in the Fusion section or page of the app, we'll have leveraged loop funds that will be live. We'll have index vaults, which is like this index vault is something that I personally am very much looking for. It will be a risk-weighted, very interesting product in collaboration with a third party, with another atomist. We'll have algo trading strategies, DEX LP vaults, a number, like really a large number of vaults that are coming up in Fusion, in the Fusion ecosystem. And obviously any vault that maybe you have an idea of creating, we'll be happy to work on and get it out in the Fusion dashboard. So with that, I think, yeah, we should end the call. It's a little over 1 hour, which is perfect. As I mentioned, we'll get the recording on YouTube and send it out in our follow-up email. So thanks everyone for participating. Thanks to Mao for doing this very detailed overview, and thanks to Łukasz for supporting and answering questions at the end.
Thank you, guys.
Thank you very much, and see you guys online. Bye-bye.